Thales stock has been on investors' radar lately, and with the defense budgets around the world hitting records high, that's no surprise. But with the share price climbing steadily, the question is Thales still fairly valued, or are we entering overvalued territory? Let's get to it. Welcome to another video. My name is Robbin, and as per usual, I'm joined by Kirill. And today we'll dive into the company called Thales. It's a French aerospace and defense company. And with all the tensions rising in the world, we thought it would be a good idea to check out this stock particularly. There are other stocks around the globe that we could have looked into, but some of them have been having crazy growth lately, and we're already in the overvalued category, some with crazy PEs. We're gonna dive into that, but first we're gonna give you our loadout of what we are gonna discuss today, which is gonna be what's in the news. Then we're gonna go over the fundamentals of the company. We're gonna go into the important ratios, and we'll leave you with the value that you're gonna get out of this video, the valuation of the company. But guys, as per usual, this is no financial advice. We are just hanging out talking about stocks, and if you want to use the valuation, then use it as the starting point of your own due diligence and do so with our web app. But Kirill, what's in the news?
Well, I mean, it was actually Robin who proposed this company today because he has direct interest in it because he already opened his position. So for me, it's also going to be more like a curiosity video. So I guess Robin is going to take the majority of the lead. But what we can at least say is that there were some of the news here and there, but I think it's also more important to talk about quite an explosive growth of the stock itself, of the stock price. It's almost 85% year to date. And of course, I think more importantly, we need to talk about what Thales actually is. So it's headquartered in France, in Paris, and they're mainly focusing on several segments, as you can see on our app. So we're talking about defense, aerospace, cyber, and digital. So they have various products and services we offer there. And recently, also one of the reasons why we decided to have a video about it is because they have announced a merger agreement between Airbus, Thales themselves, and Leonardo to join their operations in the satellite department, which also created some good positive feedback from the investors, at least today. So it's 3.7% up, which is quite nice to see, of course. And that's pretty much why we are here. So it's pretty interesting to see how does Thales compared to, let's say, comparatively to the other quite expensive defense stocks, is feeling itself on the market. Is it maybe a potentially a buying opportunity or not? So Rob, take it away. Take it away.
Let's go into. So let's go to the fundamentals first. So what do we see here? So they have a yearly dividend, a dividend yield of 1.48%. Operating margins of 9%, gross margins of 25%, which are pretty good signals. Something to be worried about is the PE ratio, which is sitting at 50, which is quite big, but we also have to understand the context here. So, of course, there has been a boom in this industry lately, ever since, I think, 2024, especially with some of the European defense agreements that are being made. So this is going to boost up the PE ratio, given also that they are doing high-tech electronics, which tend to be more pricey stocks to buy and own. If we look at the company foundations, we can see that they have an average revenue growth of 3.6%. But mind you as well, these are the data from all the data that we have in the 930 app, which is probably around 15 years. So we are planning on fine-tuning this in the new release of our new UI soon. We'll keep you guys updated. But for now, just keep that in mind when you're seeing these check marks. It also makes sense, of course, with the average net income growth is negative because it's taking such a long range here. But their free cash flow growth has been 30% historically, which is really good. They are able to cover their long-term debt with their free cash flow by more than twice. So they are really stable position financially. And their average dividend growth has been 30%, which is also nice to see. So at least that they're bringing some value, but they're also diluting you a tiny bit, and we will check it out in a bit. But they're also diluting you -1% when it comes to share buybacks. So they are creating more shares, which of course means that the pool of shares outstanding increases, which decreases the overall price. But we'll check that in a bit. So Kirill, let's go to the next segment. Let's go to
Maybe
financial results.
Yeah, maybe just quickly also before we jump further, I think what's important also to highlight is the margins. So again, because also keep in mind that they're producing heavily on the hardware part of things, so that's why they still have to have quite hefty manufacturing costs. So that's why you cannot really see similar margins as you would have for software development companies. So it's also something to manage expectations, let's say, as well.
Yeah, but given, of course, our philosophy, these margins would already be a good classification. And might, before we jump into the ratios, it might actually be good to check the 930 score.
Yeah. Oh, yeah. Of course. We are at C. And yeah, I mean, it also makes sense. So the lowest part is coming from the margin part of things and the growth. But then again, as Robin mentioned, we're talking about I think at least the past 10 years of the company. And the better part of the performance of Thales lies within the free cash flow growth and the stock price change. So the appreciation part of it is actually doing pretty good within the P ratio perspective, at least. But when it gets to the stock price change, yeah, it only boomed, let's say, recently in the past. I think it was a year or so. As Robin mentioned, yeah, so starting from, beginning of January, let's say.
Yeah, exactly. So there you have it. So that's something that we have to keep in mind, and of course, good to know. And we're gonna dive into it now with our ratios. So yeah.
Yeah, I'm just also
Let's see.
quickly scrolling through anything interesting. You can see that they also started loading up on debt a little bit more, but then again, it's a COVID effect potentially. Yeah, so net earnings ratio is also in the red side. Okay, also kind of expected. But at least what we can see, which is a good part of things, is that the interest expense ratio is quite good. So it doesn't really go too high, and R&D of about 22% over the past 20 years. That's also quite good to see.
Yeah, exactly. That's also what we like to see. We normally aim for around 20 or below 20%. This means that you have as a company, have a moat. But also in this sector, it's different because it's super difficult to enter this market, right? And still having that low-ish R&D cost is actually quite good, considering that they are making advanced radar systems, for example. Yeah.
And I think also especially that Thales is focusing, of course, on the European Union, serving the EU market. It's hard, even regionally or geographically speaking, to, let's say, enter it, also because of the specificity of the industry as well. So it kind of makes sense that they can still stay afloat, and they probably can get some preferential treatment, let's say, when they're let's say having the governmental contracts and so on and so forth. So it's a kind of like a company, I guess, that is too big to fail category of businesses.
Yeah, and of course, besides their defense part of the company, they also have a civil part of the company, which is also being used at least around the Netherlands as well. As far as we can see, almost all electronic readers for public transport use Thales software, or at least hardware. So yeah, besides that kind of boom on the industry now, they also have a civil part, which is also steadily growing, and of course they have to live off long-term government contracts.
Indeed. Yeah, so moving forward, we can see that they have an interesting behavior when it gets to the revenue and free cash flow growth. So in some years they have like some crazy booms, and then similar type of declines. after each of these kind of respective years, which is interesting maybe to see why. I guess it's also could happen due to some governmental contract signings.
Yeah.
So then they get a big inflow, and then they start manufacturing certain products or services to fulfill these contracts. Just pretty funny to
Exactly.
to
Yeah,
experience.
it would also be interesting to see, for example, if they would ever release this kind of information in their reports. But what I would think is that they would get like sort of a signing bonus to start a contract, and then also get payment on delivery, let's say. So that could also, um, yeah, make sense of these swings.
Indeed. And it's also being reflected in a similar way towards the net earnings growth, of course. I mean, wherever the cash flow is moving towards in the revenue, then your net earnings most likely also go the same way, unless you have some strange behavior on the expenses part.
And what's also funny to see is that they are buying back shares these years, which is quite interesting given that they have not been, um, buying back shares at such a high rate in the previous
Yeah, so
years.
consistently they've been on the diluting part, I agree, and then only starting from 2022, so only recently, they gradually started buying shares, which is also a little bit interesting, I gotta admit, because I mean, if I would be also a business owner, let's say, and then you are buying potentially an expensive asset, right? If your price going so high over the past year or so, then it also kind of begs the question, aren't there any better investments? Don't you want to just invest in your own operations, for example? But maybe they think otherwise, or it's just a part of their long-term strategy just to average it out. Everything could be
Yeah,
possible.
could be. Yeah, it's a strange, like you said, like we have a PE of 50, and it has not been this high ever, but for the past years it has been. So it's interesting to see, like you said, that management is considering this a good investment as well, given already their high PE. So yeah, there must be something underlying, and hopefully we'll find it out.
Yeah, and also something for you guys to look into. So yeah, maybe we don't know something, and they do. I mean, of course, their management, they I hope they do know something.
Yeah.
Yeah, and yeah, with regard to dividends, I think it's also kind of interesting that they're really ramping up their dividend growth, which is nice if you are a dividend investor, of course, because they are really low on debt and they're really increasing their dividends. Of course, just wanna put it in and forget about it. But and again, it begs the question: don't we have any other way to spend the money? Could it
Mhm.
be anything? I don't know. Go to diversify into another product category, let's say, or acquire maybe another business, for
Or
instance.
maybe they're just looking to buy new businesses that are really expensive. So maybe this is a strategy for them to attract shareholders.
Yeah, exactly. Also valid point.
All right. So if you go down, we see gross margins upwards of 20%,
Yep.
which is decent enough. I mean, it's not the things you will see with, for example, Apple, but we're having a way different kind of cookie here, and the margins around 10%, which is also decent enough.
Yeah, fully agree. Yeah. And for the rest, at least the cash conversion is also pretty okay. So they are really able to still convert their, let's say, investments into liquid cash quite rather quickly and efficiently, which is also quite good to see. So it means that they probably also don't have any big delays in payments behind their contracts, most likely. So that's good. So well, pretty interesting find, Robin. I gotta admit, yeah, interesting cookie.
Yes, and now we're gonna crumble the cookie further. Let's go into the valuation and see
Yes.
what you would need to put down in order to get your hands on Thales. All right, so for the average, let's see, yeah, where are we? For the free cash flow starting point, we always use last year. The only reason why we would change this is if we have other intel, or if we want to start at the other position that you think that the Free cash flow might change rapidly soon. Also, for example, if the free cash flow is negative, you might also want to turn it a bit positive because otherwise the calculations might be a bit yanky, especially for some of the formulas. For the projection period, Kirill, I would say, yeah, at least 5 to 10 years. I mean, it's not gonna go anywhere. There are also the programs that they are firing up in Europe, let's say, will also wrap up at least to 2030. So at least 5 years, I'd say.
Yeah, I think it's also a question of what kind of growth estimates we would put, because if we, let's say, would be on the conservative side, I mean, I wouldn't even mind putting 15%, you know. But if we also are gonna put in, let's say, something in the ballpark of 50% increase, and I was like, okay, wait a minute, no, that could be a little bit tricky, you know. So, yeah, let's start with 7. Let's say something in between.
Yeah, and then for the discount rate, we normally use 10%. But of course, if you want to put something else, you can feel free to do so. If you want to discount at a higher or lower rate, it's all up to you. Then for the estimated growth rate, let me just quickly go to Yahoo Finance to see if I can find something on it as well.
Yeah.
But yeah, what would your suggestion be based on the data that we just checked?
Yeah, I don't think putting something more than 6% would be, let's say, realistic in a way. Of course, we can put it more, but then if we're talking about 7% range, yeah, I wouldn't be comfortable putting more than something between the two. Let's say something more than 10.
Yeah. So Yahoo Finance is saying that it's gonna grow with 9.31% this year, 6.24% the next year.
Yeah.
When I was doing my research, and it's stupid I didn't put it up. I don't think I have it somewhere close to me. I was looking into, of course, the annual statements, and I did receive my growth rate from there on what they were thinking they would make for the year. But I don't think that I have it with me. So that's a bit of a shame. Either way, given 9% this year, 6%, so I would say 7%-ish would be a good assumption.
Yeah, sure.
7,000%.
Yeah, it's a bit of a small bug. It's also in our backlog to fix. Yeah, I noticed that a while ago.
The projected PE ratio. So the average PE ratio for the past 3 years,
35.
35.
Yeah.
So I would rather feel safe with something more towards the 20-ish side of things, right? It's quite high now.
Yeah, you know, knowing the current market where PE of 60 is even fine for tech companies, I'm like, yeah, sure. You know, it's just this whole market goes bananas. So I would say, yeah, let's do 25, for example. Just, of course, it's expensive for not such a growing stock, but that's just how the market is at the moment, and you cannot do anything about it.
Yep. And if we check the required rate of return, we put this at 11 or 12 or 10% because we are stock picking. You want some higher returns on your on your positions compared to, for example, owning an ETF. The margin of safety, it's up to you as well. So depending on how much you know about the industry that they are in and the potential upsides and downsides, you can change this. I think we can put this at 30, 10 or 20 or 30% Kirill.
Yeah, I mean, let's just do an average of 30. Just if we assume we have zero knowledge about the company and so on and so forth. So yeah, that's fine.
And then we press the analyze button. Yeah, I mean it's more or less always the same. Yeah, so the highest one to do a bit with the PE ratios, right?
Yeah, the PE ratio, the projection period as well. If we're gonna, let's say, make it 15%, then we're also gonna have a slightly different picture. But then again, it's also mainly because of the target valuation, because it goes by assumption that the PE is also gonna be progressively increasing with the EPS. So But yeah, then also the discounted cash flow formula gets a little bit better. Mm, but I mean, to be honest, I kind of feel that it's sensible in a way that P of 50 for the company that is, yeah, growing 6%. I mean, I understand that this whole situation in the world begs for bump up in prices of the stocks in this defense sector and stuff. I mean, there is a reason for why people are going for it, I guess. So yeah, kind of.
Yeah, there are just a lot of talks in the European Union about how they should tackle the whole defense industry at this moment. And the talks are that there must be heavy investments also from the side of NATO. So it has to go somewhere. But the question is, of course, at which companies it's going to land. There are some companies that are more in the news than others, of which Thales is not really one of them. So yeah, it's up to you if you're willing to buy it almost as twice or more, yeah, about twice the target buy price with the margin of safety of 30, and kind of a small margin when you just look at the average valuation. And with that,
Yeah, and also just before Robin wraps up, yeah, and it's also keep in mind that we have rather, I would say, more or less conservative assumptions as well. So if you are more knowledgeable about it, and then you know that, yeah, let's say the P of I don't know 100 and the free cash flow growth of 49 is realistic. I mean, of course, we can put it up and then see a completely different figure. You know, of course, the sky is the limit, and
yeah,
but then again, it just begs the question of how realistic it is,
exactly.
how much you're willing to pay. So that's it. Simple.
All right, Kirill. And my final question, as always, is where can we get the app?
Yeah, and I would with pleasure answer this question to you. So we go to 930.com, and of course the link will be in the description. We are soon gonna be updating the app. We are testing the new update at the moment. So if you would like to also reserve the current prices right now, you can do that. But then we're also gonna update the pricing point, which is gonna increase. But if you just want to get a hang of it, you can just go ahead and check the free version of it. Just poke around, see if it makes sense, if it fits your investment style or not. You can also check more of our videos on other companies because we did quite a few of them. So yeah, stay tuned, stay with us if you're interested. And also let us know if you want any other specific companies that you would like us to address.
Definitely. We're happy to look into all kinds of companies, right, Kirill? And with that said, Kirill, thank you for your lovely insights. Thank you for watching, and we'll see you guys in the next video. Boom, 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 boom.